Hey everybody, it's Ed Zoller with Villa Realty Group, LeeCountyMarketUpdate.com with your end of October real estate update. I'm going to keep these short for those of you who don't know me. I'm a real estate agent with over 20 years experience selling right here full time in Southwest Florida, and I've been tracking the market ever since 2010, and I wanted to give you kind of an update on what's going on in the real estate market. We had a lot of big changes last month with the interest rates dropping, the Fed's cutting the rate, and we want to see what that did. Well, this update's going to answer that. So first thing we're going to look at is inventory. This is always what makes all markets, supply and demand, so the supply part of it. Well, our inventory, as expected in October, went up 3%. We are at 9,700 homes for sale. And I made these arrows. What I did was I copy pasted so they're exactly the same size. And I put the tail end of the arrow on every single month that it went up. And I believe that month is September. In September to March is we had this increase, and you can almost see the increase is almost identical. So pop that same arrow over here, put it to September, which is halfway in that line there. And if that's the case, if this repeats exactly what happened in 16, 17, 18, and 19, then we should have over 12,000 homes for sale. But right now, for this month, inventory went up. We expected it. It went up here and here and here, and it went up here. Remember, last month, if you watched my update, it went up 1 month premature. So really, the bottom, all three of these bottoms are the same exact month. This bottom's halfway in this line and already starting to go up again. But a 3% increase of inventory usually means lower prices and price reductions. Demand. Now this is a shocker. I had to double check this. In the month of October, Lee County, that's 5 cities, that's Fort Myers, North and South. We got Lehigh, we got Cape Coral, Estero, and Bonita Springs. All that combined, all 5 cities, we sold 731 homes. And put that in perspective, our average home sales per month is 1,826. We sold 731, and that makes a new 40-year low. So I even put in here, isn't it funny that the number one right now, October, number one worst sales in Lee County's history is this month. Second was January of this year. Third was in August of this year. And fourth was in September. 4 of the worst months we've had in 40 years, all happening in 2024. So a lot of people are asking, where are the buyers? Didn't interest rates go down? Where are the buyers at? We're going to kind of get to that toward the end. But interesting that we dropped 28% in 1 month. So buyers are low. So you would think with high supply and low demand that our prices would go down. Well, it actually went up 1% because it is one big stubborn mule right now. I mean, it's insane to me if you really graph this over since 2000, 20-something years of pricing history right here in this graph. You see how nice and smooth it is? It almost looks like it's part of a video game, like you want to jump that hill or mountain. And so this was our boom, and this was our bubble pop, and this was our bottom, and then it just kind of slow and steady up the mountain. And then we had our huge boom after COVID. And then look at the jaggedness. Look at the little dips. The only thing I can see is this little dip. This little dip is lower than this one, and maybe it's just going to be one of those stubborn things. Why is it doing it? We went over that a couple market updates ago. Builders, instead of dropping prices, are offering incentives. Like the house could drop 80 grand in price, they'll make the monthly payment like it's lower, but they won't drop the price of the home. They'll offer up 40, 50, 60, 70, up to a 90,000 worth of incentives to buyers in the form of interest rate reductions, closing cost help, concessions, buy downs, all those things that make it affordable-ish, but the price is still high. So that's why this has kind of been a stubborn bear. Are we affordable? House payment as compared to the average household income. So no, this graph is over this line, which is what our long-term 10-year average is of what people can afford. And you can see this. In 2005, they couldn't afford homes. We were in the 40% of someone's gross income going to a mortgage. That's not sustainable. And it went all the way down to where it was almost down to 16% of gross income was going towards that. And then it kind of hovered and stayed around the 20s, did a nice little dip after they cut interest rates. And these are the times when we had 2 and 3% interest rates. And look what happened come 2022. We became unaffordable, skyrocketed even bigger than this rocket here. and now it's kind of on its way down. So actually going up a tick from 38.35 to 38.4 is not really that much at all. But it's funny that the income did go up, but so interest rates went up too. So that kind of offsets it. I did calculate that an affordable home right now in Lee County, based on our current income, household income, is $1,573 a month. And right now, that average home is $2,328, 32% overinflated. Does that mean prices are going to go down 32%? No. Combination of insurance rates, taxes, interest, price, income, all those we has to adjust down. If people are making more money, then they can afford more for a home. If taxes go down, that will also all help this ratio and this graph. And until we hit here, I will say that we're in an non-sustainable market. Home value growth is what I do is I take the Zillow home index value, graph it out since 2000, and you can tell when the market's appreciating. And I want to see how, look at how standard that is right here. And this as well. Real estate appreciates about 4 to 5% on the average a year. It is a great investment for people. It's a hedge against stock markets. It's a safe investment. Investors buy it. We buy it. We make money when we sell the home because the house just keeps appreciating in value year over year, year over year. But come 2007, we didn't. We crossed over this graph because we had this huge boom of appreciation. And then we had this twice as long dip where it was losing value. I counted all these dots, 59 dots until we hit stabilization. We hit it once. We went back down, we back tested that 0%, right back down again, and then it skyrocketed and it went back to normal all the way from 2012, I would say, all the way until COVID 2021. But then look what happened. This huge, huge increase, huge, fast appreciation. Houses were going up 2, 3, almost 3% a month. And then what has happened since? We got low, we tested that support, and now it has been 15 consecutive months. And I remember when I showed the first, I couldn't say first consecutive month. It was the second month. I had to say the second. I'm just counting this. Is this going to last as long as this back here, which took 59 months? Don't know. The further from this line you are, and I do like that it ticked back up a little bit, but the further from the line you are, if someone says, has our market stabilized? No, it needs to hit this, show support there, and I will say then we have a stabilized market. Before a market can go up, it has to stabilize first. So price cuts, this is the good news. A couple, 3-4 months ago, I was telling you that we were leading Florida, and as a matter of fact, we were leading the state in price reductions. 40% of all listings were dropping their price, trying to figure out where support was, where their house value was. And now we've actually gone down to our long-term average of 22%, almost on the nose. So how I attribute this to is when agents like myself go to a house and we talk to an owner, we are not going to give them fluff. We're not going to pretend it's 1 year ago and the houses are selling like hotcakes, because obviously you see they're not. The lowest demand, the increasing supply, you need to price yourself accordingly, and you need to price yourself to get out of the market fast. And if you do that, then you're going to see not so many price reductions because we're going to price it accurately to sell the home faster. So that's a good direction that we have gotten back to normal. So let's just go over the differences. Homes for sale up 3%. The sold homes dropping 28% from 1,000 down to 730. The pending sales ticked up. Remember, the 1,200 pending sales last month equated to 731 closings. So therefore, if this number is bigger, I do believe, based on all this information, that we are not going to break the record next month. We should have increased sales. God help us if it does break the 731. Totally looking at this to see, kind of give guidance towards the market, but 731 is a horrible, horrible number. New constructions have increased by another 61, up 3%. And if you look at this, 2,000 homes out of almost 10,000 is 21%, 22% of our entire market is new construction. As a matter of fact, when I looked at the sold homes of 731, 35% of all 731 were new construction. People were going to new construction because of those incentives. The time on market was kind of amazing to me but you got to remember, when you have not 16 or 1,800 sales telling you an average time on market, this is an average. We only had 700 sales. So if things lasted a long time, then this number doesn't mean that much when you have lower data points, lower sales volume to justify this price. Our asking price went up. As you saw, our selling price went up a tick from last month, and the asking price to sold, so what someone's asking and how much it actually sold for, did go down a tick. Not that important data that I look at, but it does give you an idea that if you ask the right amount, you might not get that, but you'll get within 4% of that. But the big news is 40-year low of sales. All right, so kind of some of the new stuff. One I want to talk about, this is a graph I did last month, and I just like to pinpoint this and update this monthly. This little line here is the median income of Lee County, and you can see that it humped here in 2008, and then it went down a little bit because we had a market crash, and then it's been slow and steadily going up, a little spike in 2020, and then obviously COVID happened, we had a drop of income, and then it's been going up, and now it's kind of flatlining. Currently, we're at $72,600 average household income. So what I did was I took assuming that the household spends about 30% of their gross income on the total house payment. I looked to see, what do you need to make to afford the average home? And as you can see here, from the years of 2010 all the way to 2022, the salary of Lee County employees on the average could afford these homes. But now look, not $72,600 income, you need to make $93,000 to afford the average home. That might explain why we have very, very low buyer demand. Well, not a lot of people make $93,000 in Lee County when the average only makes $72,000. So something to kind of keep track of, and I'm going to kind of modify the graph, obviously, but I'm going to modify these numbers so we can see these numbers need to get closer to 72,600, or this number needs to climb up to that. I don't see that happening this year. So buyers or sellers market, it's not a shock. I told you guys last month, after extreme buyers market, I did not ever see us having more than 10 months of inventory. I didn't even know what to name these. But we shot now over a year's worth of inventory. With these low sales, it would take over 13 months to chew up what we have right now for sale. So I call that the wicked, crazy, once-in-a-lifetime buyer's market. And if we go above 14 months, I'm just going to say this is stupid. Because when you get below this line, we call that a seller's market. When you go above it and way above it, like this graph is right here, this is just where buyers have all the leverage. The higher the severity, the more leverage buyers have over sellers who really need to sell. And so as you can see here, it would take a long time for us to get rid of this inventory that we have building up right now. So where have all the buyers gone? I just want to do this quickly. You can read along with me as I go over this, but I asked the question a long time ago to people, about a year ago, when do you think in history of Lee County that we had the most percentage of investor purchases? Was it A, during the real estate crash of 2009 when homes were 70 grand? B, the building boom of 2005 where people could get 10 loans for houses, so in essence, leverage 10 homes for the price of one? C, when interest rates were 3% and the home price were less than 200 grand, so they cash flowed marvelously for investors? Or D, 2023, the peak highest price the house has ever been? And wouldn't it be shocking to say that the answer is D? 2023 was the peak of our investor purchases. 25% of all our purchases were made in 2023 or from financial institutions and investors. That's a level we have never seen before. And I want to let you know, so people are like, well, what, investors stupid? All these investors bought, and they bought at the high, and now the prices are going down. No, it's something investors call the spread. And I just want to explain this really briefly to this. This is the spread. This blue line here is the cap rate of real estate. This red line is the 10-year Treasury bond. It is the safest investment you can probably have. Buy something, lock your money for 10 years, and you will make this interest rate on that bond. And there's been times that it's been above 3%. There's times that it was below 2%, and actually a time it was below 1% on a bond. Wasn't paying a lot of money. So you got to look at these gaps. In 2012, investors saw this huge spread between real estate and bonds, and that's why we had a lot of investors purchase, not as many as purchased 2023. Well, look what happened in 2023. This yield was actually really, really good. But when Treasury yields go up, and at one point in the beginning of 2024, it was safer to buy a bond than to buy a house. And houses usually, reward people 3 or 4 times the value of buying a bond because there's some risk involved. Tenants might not pay that month. They may have to be evicted. The house might have something that breaks. Tax insurances can go up. Taxes can go up. There's some things that is a risk, but people make that risk when they're investing in real estate because it is a 3, 4, 5 to 1 risk and reward. So very, very little risk and high reward. But now bonds up to 4%. That is the reason why everything that happened this month is happening. Investors pulled the plug. They have their homes they bought in 2023. There is a company that is one of the biggest hedge funds in our country that bought a bunch of homes in Florida. Most of their homes have a name of SFR, stands for Single Family Residential Acquisitions, 1, 2, 3, 4, whatever they want to call it. There's a lot of SFRs out there. And I have seen in other parts of Florida where they're dropping 50, 80, 100 grand off their prices, taking 100 grand losses on their houses. Why? So they can take their money back out. They don't even blink an eye. And they can put it in something either safer or stock market or options or whatever they want to do with that money because they are working with big, big money. That's how our market has gone down. But there's a couple other things. And what's so important about the 10-year Treasury yield is it also is something that's a factor of the interest rates. So you guys can read all about how spreads work for investors. But let's look at the mortgage rates. This is when Powell cut the rate a half a point, 50 basis points. And look what happened. It went up. Why is that? Because Feds do not set the rate. When they cut interest rates, they can manipulate it, but they do not set rates. Banks do. So when the Feds say we want our Fed rate to be blank and we're going to take this off, you usually look at the 10-year Treasury. And remember, we saw that it was about 4.2% is today's Treasury, and the Feds cut the rate. But by the time you add that Fed rate to the Treasury rate, that will equal now what we're looking at is a 6.5% interest rate, and this is on an FHA loan. Conventionals are above 7, but that FHA rate before the cut was 5.75. That's a 13% increase of interest rates just in the last few weeks, and that impacts affordability. So just something, it's kind of the 1-2 punch. When yields go up and bonds go up, then investors will pull out and put stuff on the market and increase inventory and stop purchasing, which lowers demand, but it also increases the interest rate, which also lowers demand and increases inventory as people want to sell, or maybe they have to sell and they can't refinance because interest rates are higher. It's called the old 1-2 punch, and that's why we're seeing such drastic things. So overview, our inventory went up 3%. Our demand hit the lowest in 40 years in October, a 28% decrease. Pending sales did tick up a bit because I do not expect just only 700 sales next month. The home value growth is still what I would call unstable. We are not stable yet, and as interest rates did go up 13% just after the Feds cut their rate. That impacts both supply, demand negatively, as well as investors. So the data points for all my market updates. And of course, if you guys have any questions, or you can always give me a call. There's my cell phone. I'm going to have this update and every month update it at LeeCountyMarketUpdate.com. For buyers out there, I'm telling buyers to be patient, that the deals will come to you. It's a market of falling daggers. Do not reach. You'll get cut. Let the feather fall gracefully into your hand. But being prepared, it may not be this year. It may be the middle of next year. But you want to be prepared so when we do stabilize, you are going to see people kind of flood into the market. But I'd rather have you prepared and ready to go as opposed to not, or waiting to fix your credit, or waiting to save up money for a down payment. Who knows what the market's going to be like, but it will go back to average person buys the average home with the average price. And in my opinion, it's been something I can say throughout the history of real estate as long as I've been doing it, as well as going all the way back into history as well. Hope to hear from all of you. For sellers out there, I would say you still have a lot of that fake equity that COVID gave you. Your house is still worth a plenty more. And if you price yourself accurately, you will be one of those few sales. Obviously 731 sales did happen for people. So, but that's about being educated about the market on your particular product and see what that kind of supply and demand is for that. You guys have a great one. Talk to you later. Bye-bye.